All right, welcome back. I'm Jeremy Szafron. Now, we've been warning for months that the inflation story wasn't over, and now July's wholesale price report makes that impossible to ignore. Now, the producer price jumped 0.9% in a single month, according to the BLS. That's more than 4 times what economists expected, and the biggest monthly gain in over 3 years. And core PPI matched that rise. And services costs, that's the Fed's main focus, it climbed 1.1%. Now, a big part of this is tied to President Trump's new tariff structure, 10% on most imports, 15% on many EU goods, and higher rates on rerouted shipments. Machinery and equipment wholesaling accounted for a large share of the increase, along with portfolio management fees and even airline fares. Now, the market has dialed back the odds of a September rate cut from a near certainty to about 90%, according to the CME FedWatch tool. Joining me now is someone who's been in the inside Fed's decision-making rooms, is Danielle DiMartino Booth. She's a former advisor to the Dallas Fed, the CEO of QI Research. Danielle, good to see you. Welcome back.
Thank you. Thank you, Jeremy. Good to be here.
Let's unpack this latest data. I mean, it comes fast. Let me tell you, nearly a full % increase in PPI in 1 month. What are you seeing here? Is this mostly tariffs, or are prices accelerating across the board?
I think it's a combination of the tariffs, for sure. We knew that these higher input costs would show up somewhere, and now we've seen that happen. And it's also another thing you mentioned, which is portfolio management fees. And that is really a reflection of asset price inflation. Portfolio management fees go up when assets under management rise. So in other words, they're a direct corollary to what's happening in the runaway stock market.
Yeah.
So it's a mix of the two. There is a negative spread between the producer price index and the consumer price index. Investors typically do not want to see that, because that is indicative of the producers not being able to pass through these costs to the consumer. And a lot of the areas we've been seeing really hot inflation, furniture, RVs, these sales we know are down. And some of that has to do with the other side of the Fed's mandate, and that is the employment mandate. So we have to be very cautious here, because profit squeezes are not market friendly.
Yeah, you're not kidding. And of course, we have these new numbers in Q3. I mean, we also, you talked about that gap between PPI and CPI. Is that, genuine economic divergence, or is it kind of partly because of a result of changes like the BLS's new wireless price methodology, all these new ways that they're trying to look at data points?
No, I think it's probably pretty real. When you follow things like Trueflation, we have seen a little bit of upside there. It was, I think, at 1.99%, the most recent check of that. But we're certainly not seeing the magnitude of increase that we're seeing on the producer side filter through to the consumer. A lot of this also has to do with the fact that shelter is under great pressure. Through no product of the tariffs at all. But shelter is the largest weight that goes into the CPI. And we are seeing an increasing number of cities across the United States with falling home prices.
Yeah, Treasury Scott Bessent, Treasury Secretary, obviously, he was telling Bloomberg this week that rates should be 150 to 175 basis points lower, warning that Powell risks staying too tight for too long, which, you've talked about this, but let's take a listen to that clip.
What if the BLS data had been the higher quality and we'd had those numbers, Jonathan? So if we'd seen those numbers in May, in June, I suspect we could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. And I think President Trump is very good at giving these nicknames. And I think the reason that the Jay Powell gets the nickname too late is because he wants to go into a series of rate hikes. He's not Alan Greenspan, who was very forward thinking. They try to be more data driven, which I think is a mistake, because I think we are going back into an economy like we had in the 90s. So, it's just very old fashioned thinking, but I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September.
Danielle, he's arguing that this isn't really about weakness. It's about avoiding unnecessary damage from over tight policy. Does that reasoning hold up in your view, Danielle? If the Fed cut by 50 basis points in September, would the inflation risk outweigh the growth benefit?
So, it's very hard to say. I understand where Treasury Secretary Bessent is coming from. Obviously, had we had the May and the June data that was revised and revised materially lower before that July meeting, we probably would have seen that first 25 basis point rate cut at the July 30th meeting. So, I see where he's coming from, but rate cuts to me, and I was only on the inside for 9 years, so what do I know? But rate cuts typically accompany slowdowns in the economy.
Yeah, yeah. And I mean, I was watching the tape when you joined us back in June, the last time you were on the show. You said that the private sector was already somewhat in a recession even before the data confirmed it. Now, with wholesale inflation up, we got continuing jobless claims near multi-year highs and then delinquencies rising. I mean, do you see that call being validated?
Well, certainly. And we've also had another large revision to the payrolls data that validates the fact that net job destruction began in the second quarter of 2024. There's a certain irony in terms of how market participants are treating this big shock downward revision in July. But when you add it all up, 24 of the last 30 months have seen downward revisions from what was originally reported by the Bureau of Labor Statistics. So this is nothing new. And we are indeed seeing the vestiges of this. You mentioned delinquency rates, whether it be credit cards, and now we're going to pile on the effect of having to repay these student loans. So, I don't think that the last chapter has been written in terms of distress on U.S. household bank sheets.
Yeah,
Excuse me.
these initial jobless claims dipped kind of last week, but the continued claims remained elevated. Which tells the truer story?
So remember, an initial jobless claim is exactly as it sounds.
Right.
You can apply for jobless benefits. You can apply for unemployment benefits. Will you get approved for them? Mm-hmm. In many cases, the answer is no. States spent an extraordinary amount of money in the aftermath of the pandemic hitting the U.S. economy, and states are much more reluctant to approve a jobless claimant, and that is why we look much more at the continuing jobless claims, people who have gotten through the process and are receiving continuing jobless claims, as being the truer indication of the state of the economy, to say nothing of the fact that we have millions upon millions of gig workers and individuals working multiple jobs part-time for economic reasons. They're doing this because they can't get jobless benefits.
Right. Yeah. And you talked briefly about those student loan delinquencies. I mean, they're above 10%. Credit card delinquencies near decade highs. It doesn't really fit the strong labor market narrative. But I guess my question is, if full-time employment is slipping, participation is flat, is this already a jobs-led slowdown?
Oh, I mean, that is typically what we come to know. Yeah. People talk all the time about the non-farm payroll survey response rates being as low as they are, but for heaven's sake, the unemployment rate, the sister survey that creates the unemployment rate, also has very low survey response rates. And I think that that's one of the reasons, when you look historically and plot out the data, that the unemployment rate seems to be out of step with the very high levels of distress that we're seeing on household balance sheets. Something is incorrect here. One of the two is not correct, and I think we're discovering that. And we had a subprime auto lender last week just pull the plug, just say we're no longer in the business of making car loans, which means we're no longer in business.
Yeah, I got to ask you about the data quality, because, of course, we just heard Bessent talk a little bit about that, data dependence. We had these CPI mythology changes. We had this discontinued kind of PPI series. And then, of course, these big revisions to those past employment data. How much does that complicate the Fed's decision making here? I mean, we got a new guy in the BLS.
Yeah, so it remains to be seen. I certainly think, and I've been saying this for months, that we need to revisit how these data are compiled and reported to the public. They're extremely important. This is not China, where you just say, okay, take it with a grain of salt. That's certainly not the standard that we should have in the United States. I do think we need to look at how to better align actual company headcounts with what's reported to the public. And I suspect that this quarterly census of employment and wages is pretty simple for the head of human resources to report on a quarterly basis to the Census Bureau, and that is then provided to the Bureau of Labor Statistics. Why don't we ask companies once a month what their headcount is and just go straight to the source?
Yeah, EJ Antony's been on this show. I'd be curious to see what he does there. You've been in the rooms, you've advised the Fed. When data contradicts the policy narrative inside the Fed, do those concerns get a real hearing, or does consensus override them?
I certainly think that right now that consensus has been a force.
Yeah.
On the other hand, prior to Michelle Bowman dissenting, we hadn't seen a dissent since 1995. So it's apparent in the fact that there is greater frequency among Federal Reserve Board members, that there's greater frequency and even a higher number. We had 2 dissents, that there's definitely disagreement on the Federal Open Market Committee. And in fact, we've seen that accelerate and grow in numbers such that if you play it out, you could possibly see 6 dissents at the September meeting.
Yeah, that's never been, I don't think, has that ever happened?
Actually, prior to the transcripts being provided to the public, Paul Volcker, infamously, for people who follow Fed history, had mutiny in 1987 on his Federal Open Market Committee. There is precedent to this, but it would really rattle markets, I think, to reveal that kind of that level of disagreement among the 12 voting members, if we do indeed get the nominee confirmed by the Senate prior to the Fed meeting on September the 16th and 17th.
There's been a lot of names being floated around. I mean, even in that Bloomberg interview with Bessent, he was being a little tight-lipped. I think he said something about he's looking at a wide net of 11 people for potentially to take over Powell. Who are you hearing about?
I think that the market's money was on Kevin Hassett being named to replace Governor Adriana Kugler after she left. I think the markets were surprised that that was not the route taken. And now that Bessent has cast such a wide net all the way out to Wall Street strategists, it's very difficult to see what the thinking is. And you have to bear in mind, there is reputational risk for a true academic type of economist if you're being publicly nominated to come in as an effective puppet. And with the administration and the Treasury Department being your puppet masters. So maybe it's more difficult to fill the position than it was because of how it's being cast as controlled monetary policy from others, which is the opposite of independence.
Yeah, I've talked about Powell and what his legacy is kind of leaving this position, and he's been very careful, obviously, about, coming out saying the same things, this and that. What is his legacy at this point?
So I've been critical of Powell. Again, 24 of the last 30 months, we've seen downward revisions. It's not as if somebody's hiding this data from him. I think he is too late to the game in terms of easing monetary policy. But we don't know what his legacy is going to be. We don't even necessarily know that he's leaving next May. He has the right to stay on and finish his 14-year term that ends at the end of January 2028. It's exactly what Mariner Eccles did. The Eccles building is named after him when President Truman in 1948 was strong-arming him. Eccles was not renominated to be the chair of the Fed, but chose to stay on as a governor so that he could prevent this collusion from occurring between the Federal Reserve and the Treasury. Powell can remain a thorn in Trump's side, is the bottom line.
Quite the leverage. I got to ask you about tariffs, because obviously it's starting to show up here. But the U.S. is on track for over $150 billion in tariff revenue this year. It feels like a bit of a fiscal boost on paper. Is it outweighed by the inflation drag? Could the revenue meaningfully improve the Treasury's position here? Or is it just too small to matter against any recession risks?
Well, It's nice to have money coming into the nation's coffers, or maybe we'll
Yeah.
just collect 15% of chip revenues and come up with all kinds of fun, interesting ways to go about this. But when you're talking about a $2 trillion deficit, it's simply not enough, I think,
Mhm.
at this point. And the uncertainty that is engendered with these tariffs, the paralysis in corporate America, the hit to profit margins that we were just talking about, these things are very real, and they act as economic offsets to the benefit of tariffs, at least to the nation's profit and loss statement.
Right. Let's jump into that. I mean, because obviously it's an interesting market. So where are you positioning capital at this point? I mean, if the Fed holds in September, is it smarter to stay short in bonds or extend duration?
Well, we've been telling our clients that no matter what they do, to be up in quality.
Yeah.
And I do think that it's a safe bet to be at positioned at the short end of the curve. I do think we're going to see more rate cuts than what had been priced in just a few months ago. But again, we've been advising our clients to quote unquote stay up in quality. And that means be very careful about taking on credit risk in this environment. We are seeing, the highest level of bankruptcies continue to come through at the highest level since 2010. And my gosh, they're growing in size. It's become commonplace to see multi-billion-dollar bankruptcies being announced typically after the close, when hopefully everything's quieted down. But we're in a very tenuous situation with credit, and you're not being compensated for that. And you're certainly not being compensated for the risk that you're taking on in the stock market, which is not to say that this momentum train is pulling into the station. Momentum is a very difficult thing to slow, and it's clearly on the side of stock market bulls.
Mhm.
But I would be very careful here in terms of taking on specific credit risk.
Yeah. Okay. Well, I mean, I can ask you. I mean, I know you won't give it all away, and for those at home, I mean, you do have a great Substack newsletter. But which equity sectors kind of would benefit most under the current tariff regime? And then we talked about margins. I mean, which would face the most pressure?
I think something as defensive as healthcare, and they're certainly in a cost-cutting mode right now. Anything that's going to benefit, obviously, from demographics in the United States would be kind of a safer bet to make compared to when you see headlines that show that a multi-billionaire is selling 8 of his data centers. And I think taking on risk in the technology sector is definitely only for the people who would see. If you ask them, "Are you risk averse?" they say, "Hell no."
Yeah.
That's the kind of an environment that's kind of risk aversion that you cannot have if you want to be playing in this market right now.
Gold is holding above $3,300 still. I mean, miners seem to be finally outperforming a little bit of bullion here
Yep.
on that. Is this, structural demand, or do you think it's maybe a possible profit-taking zone?
Well, we have to be careful when we've got over $1 trillion of margin debt sitting out there, which is a record level. Because in environments like this, if there are margin calls made, if there is
Mhm.
disruption in the market, gold can be very tricky on a very short-term basis. I still find it to be a core holding, of course. It's just when margin calls do come in, if they come in, investors often reach for what is the most liquid part of their portfolio. And as we saw in the immediate aftermath of the pandemic, that was their gold holdings.
Yeah, yeah. And I guess for the contrarian angle, I mean, if tariffs persist and rates are cut, could the dollar strengthen and maybe gold weaken, breaking the usual pattern here?
So anything is possible. Look, we saw
Yeah.
the dollar weaken when other central banks around the world were cutting their interest rates and the Fed was holding pat. So it was a very counterintuitive moment for the dollar, in that the Fed was, relatively speaking, much tighter than other central banks. So, as the Fed starts to ease, could we see the dollar strengthen? Anything's possible, especially if you're a contrarian minded investor.
Yeah. Okay. Before I let you go, there's a little lightning round, and it's quick. I mean, it's just buy, avoid, or hold. Were you looking at any small cap value stocks?
No, I'm
No.
not.
Yeah. Just avoid. Okay. What about emerging markets, kind of excluding China at this moment?
So I think emerging markets are an interesting play. I think that we are going to see the supply chain rerouted again to
Yeah.
a certain extent. The countries that are on the countries that benefit from having manufacturing moved, onto their shores, they could certainly be good plays here.
Okay, and what's the single market indicator that you're kind of watching for before we get you on the next time, Danielle, that could warn of a hard landing before the Fed admits it?
So I'm really at this juncture again because high yield spreads are literally the lowest on record. So I am watching the MOVE index, which is technically interest rate volatility, but sometimes when the MOVE index becomes unhinged, that means that credit will follow. So I'm watching if I was on a desert island and you said you get exactly one on your Bloomberg terminal, I would say the MOVE index.
All right, you heard it right here. Danielle, thanks for joining us. Appreciate you making the time today.
Thank you.
Thanks. Danielle DiMartino Booth, the CEO of QI Research. We'll link to her insightful Substack newsletter in the description. Now, if you're watching, subscribe. Let us know in the comments where you see the economy heading. We'll keep bringing you the conversations and the data. I'm Jeremy Szafron. See you next time.